So while we had calculated CFO using the direct method, we had actually assumed something. I'll tell you what that assumption was. We started with sales and we said sales was 1000, and this was through the accrual method of accounting, and we had assumed that cash was 800. Now this was an assumption that we had made. This will not be provided to us. In fact, this is not given to us. So how do we actually find the actual cash positions of the company from the income statement that we have? So if you look at, we have the income statement, we have the balance sheet, and if you apply your mind, you'll find that if you look at both of them cohesively, you will be able to understand what is your cash position under the individual items. Let me show you how. Let's say that this was the transaction here, accrual accounting 1000, and 800 was the cash. So what would have happened is, in this case 200 would have been your accounts receivables, right? So now let me give you some hypothetical balance sheet here as well to make my point. Let's say that the sales numbers were for the year of 2011, and for balance sheet we have 2 points in data, 2011 and 2010. So accounts receivables, I'm just talking about this only entry which has been affected by sales. Accounts receivables within the balance sheet will be classified as current assets. Let's assume that this was 1000 in 2010. So before this year this was 1000, so that means at the beginning of the year, and since 200 was in addition to these receivables, that means that in addition during the year 200 worth receivables were formed. So what will happen for 2011 will be that your receivables will be equal to 1200. Okay, so this is one point that we note. We have the previous account receivables data and we have this year's accounts receivables data. There has been an increase in accounts receivables to an extent of 200. So note this 200, note this 200. So we actually look at the difference of the balance sheet items in order to understand what has happened within that item. So an increase in accounts receivables actually mean that there is an increase in current assets, correct? So if there's an increase in current assets, what would think intuitively that if you have to buy an asset worth 200, what will go down? Say for example you're buying 200 pens, obviously those will be assets. So if I'm buying assets, your cash will go down. So think about an intuitive relationship that when assets go up, your cash moves down, correct? So if we apply that same logic on accounts receivables have increased by 200, so that means cash would have gone down by 200. So I'll use this logic and I'll use the accrual sales in order to come to the cash sales numbers. So here what we will do is your cash sales will be defined as sales which is given in the income statement plus or minus. So this account receivables may increase or decrease. Here there was an increase in accounts receivables. An increase in accounts receivables mean that there has been a cash outgo. So I'll subtract this increase in receivables. So essentially I'm saying that this should be 1000 minus an increase in accounts receivables, that is equal to 200. So this number comes out as 800 here, and here we had gone by an assumption. Here we have actually found using some logic. So this is the kind of logic that you will always have to follow while you calculate the cash expenses for other items as well. So let's look at how COGS can be found using the balance sheet items. So let us now look at how COGS cash could be found. We have earlier looked at this example where COGS was 500 and we had assumed that cash was around 400, and The remaining amount, that was 100, was classified as current liabilities, and within current liabilities it was called as accounts payables. So this comes in the income statement, and what we have noted is cash is 400, and again this was an assumption that we have made. Now what do we require in order to find this cash item? We require the balance sheet amount of 2010 and balance sheet amount of 2011, assuming that this income statement was made for 2011 here. So I'll just input accounts payables. Let's say accounts payables were 1200 to start with, and what will be the amount at the end of this year? So if you look at, this is the additional amount of payables that add up to your 1200, so this becomes 1300. So your accounts payables have actually increased. This essentially means that your liabilities have increased. Now whenever you talk about increase in liability to an extent of 100 here, when your liabilities have increased, this would mean that cash has come into the system. So this would be treated as a cash inflow. So how I treat this, liabilities, I think of something like a loan which I have to kind of repay. Now if the loan amount has increased by 100, obviously I would have received cash to an extent of 100. So pick any kind of a liability, be it accounts payables or accrued liabilities, or other interest payables or taxes payables. If they have increased, that means I may have taken a loan and treat this as a cash inflow. However, think about liability when it decreases. So I again go by the same analogy, that is loans, and if the loan amount has decreased, let's say by 100 here, that would mean obviously in order to repay my loan I will require cash, and I would have paid or repaid loan by a cash outflow. So this will be treated as a cash outflow here. So liabilities, if they move up, think of it as cash inflows. Liabilities, if they move down, think of it as cash outflows. Here we have accounts payables, and we have seen that during the year liabilities have increased to an extent of 100. So this amount of 100 will be treated as a cash inflow. So let us now go and look at how this assumption of 400 can be found from the income statement and the balance sheet. So in the income statement we have the COGS as 500. So what is your cash COGS that we have paid? This will be the COGS from the income statement, and this would be, since this is an expense, this is treated as a negative or a cash outflow. And here we see from the accounts payable section that the liabilities have increased, so this would be treated as a cash inflow. So this will be plus 100 here. So this comes from the balance sheet. So what do we have is this cash COGS is minus 400. That means it's a cash outflow. So this is how you can find your direct cash, which we have assumed earlier, from the income statement and reconciling the same from the balance sheet. So take any other example, SG&A. You just have to put what SG&A was in your income statement and see whether your accrued liabilities have increased or decreased. So when we talk about SG&A, there's a formation of accrued liabilities if they are paid or if they are not paid. So you need to look at the balance sheet item called accrued liabilities. So likewise we go on and on to find out the other items like interest payables and taxes payables and cash taxes and cash interests. So let us now take a comprehensive example and kind of find an overall cash flow from operations using direct method for a company.